Okay, helps if I share the screen for the recording. Okay, so here we are, chapter 6 problem sets. These are the problems we're going to go through right here. Did we do any problems at all on Tuesday?
Yeah, we did 3 and 8.
3 and 8. Okay. Well, then it's going to be even shorter. So let's start with problem number 2 here. This one, let's see, I think this is traditional. Is this traditional? Yeah, this is a traditional overhead costing scenario. So we've got this company selling 2 products. One is called Diamond, and they sell 24,000 units of that. Here's the sales price. And then their other product is Clubs. They sell 27,000 of that product at a different price. Then we have the direct materials costs for each product. The labor rate is $25 per hour. That applies to both products. However, Diamond takes 3 direct labor hours, and Clubs takes 4 direct labor hours. We also have an estimated 180,000 total direct labor hours. We have an estimated overhead, and overhead is based on direct labor hours. Okay, so they gave us a lot of information here to work with. What is the gross profit per unit for Diamonds and Clubs? So to figure that out, we have to start with the sales price, which is 180 for Diamonds, right? 190 for Clubs, right? We see that right up here. And then we can put in the direct materials costs. So we've got 25 for Diamonds, and we had 30 for Clubs. This is per unit. Okay, but then we get to labor. So what do we put for Diamonds for the direct labor cost per unit? $75, perfect. Is that Joseph? Okay, and how did you figure that out?
You would go ahead and do the direct labor hours times the rate.
Okay, so it's 3 direct labor hours times $25 per hour. And then for the Clubs product, it's 4 hours of direct labor, so 100. Okay. Then we have to apply the manufacturing overhead. And to do that, we need a rate, right? So how do we get our overhead allocation rate?
The direct labor hours.
Yeah, exactly. So we take the estimated overhead of 720,000. And in this case, since we're using direct labor hours, we need that estimate. And so overhead divided by the activity gives us 4. Now what do we do with that number 4? So we multiply, okay. So that 4 is $4 per what? Per hour. Exactly. It's $4 per the activity, which is direct labor hours. So we multiply by the hours, which again was 3 direct labor hours for the Diamond product and 4 direct labor hours for Clubs. Okay, so that gives us $12 of overhead for each Diamond product and 16 for each unit of Clubs. Okay, so now we can get our total cost per unit. So what would that be for Diamonds? 112. How did you get that, Alec? There you go. Just add the direct materials, labor, and overhead. Notice we are not adding the sales price because that's not a cost, right? So direct materials, direct labor and overhead gives us 112. Over here, that's 146, right? And then for our last step, how do we figure out our gross profit per unit? Okay, so we subtract the total cost from the sales price. That gives us $68 for each diamond unit and 44 for clubs, right? See if I did that all correctly. 68 and 44, nice. Okay, any questions? Ellie?
How'd you get the manufacturing overhead? You divided it, and then how'd you get the 12 and 16?
Okay, yes, so we took the estimated overhead by the estimated activity, and we got the rate of $4 per hour. And they're using direct labor hours to apply overhead. So for each unit of diamonds, it takes 3 direct labor hours. So that's what we multiplied by the $4 to get $12 of manufacturing overhead. And for clubs, they use 4 hours of direct labor. So we multiply that by their overhead allocation rate to get $16. Okay, any other questions? So since I did number 3 already, this was the 1,000 picnic tables. Yeah, so we went through that the other day.
Did we already do the second part to number 2? B?
Oh, did I miss something? Let's see. Oh, maybe I did. Oh, we didn't do it. Yeah, sorry. Okay, let's do that. So let's see. Oh, yes, we have 24,000 units of diamonds. Now, if we want to know our total sales for diamonds, we can just multiply the number of units times the sales price per unit, right? And we get our total sales revenue for diamonds. How would we get our total cost of goods sold for diamonds?
Multiply the amount we sold with the direct material cost.
Okay, well, so we take the number of units that we sold and then times the total cost per unit. That'll give us our total cost of goods sold. It was 24,000 units times $112 per unit, 2,688,000. And then how do we get gross profit? Subtract. So $1,632,000. Okay, so we'll repeat that process for clubs. Now, clubs had 27,000 units sold. So we multiply that by what? We get sales. $190 sales price. Correct. So 5,130,000. Cost of goods sold, we multiply 27,000 units times what? 146. Total cost per unit. That gives us 3,942,000. And once again, we can subtract to get our gross profit, 1,188,000. Okay, and what about this column on the right, the total column? Yep, we're just going to add horizontally. That's exactly right. Just a comma there. Okay, so once we add our sales for both products, we get our total sales. Add cost of goods sold for both products, we get our total cost of goods sold. And we can do the same thing for gross profit. And then if we want to double check, since we added everything horizontally to get those numbers, we could also add vertically here, make sure we get the same result here over on the right. So if I take, or actually subtract. So we take our total sales minus our total cost of goods sold. We do get the same gross profit. So pretty good indication that we did our calculations correctly. And to be extra sure, we can just go ahead and check here. And yes, we did get the same result. Okay. So again, this is using traditional overhead costing. What about this problem made it traditional?
Direct labor hours.
Yeah, exactly. We're using direct labor hours as the activity, as opposed to activity-based costing, where you can use pretty much anything you feel is appropriate. Okay, and traditional would also include direct labor cost and machine hours, right? Those would be the three, but you would only pick one of those. Like here was only direct labor hours. Okay, so I think now we've completed problem 2, right? Any questions on that one? Again, if anybody wasn't here on Tuesday, if you want to stick around, I can go over problem 3 again, but for the sake of those who've already gone through it, I'm not going to make you do that again. So next we have problem 4. Problem 4 is this one. Oh yes, okay, this one's just a little different. Basically, it gives us all these different activities here, and it tells us if this activity is measured at the unit level or the batch level. And we have to think of why. Why would it be something that's done at the unit level or at the batch level? So the first one's assembling products. Why is assembling products something that is done at the unit level? Basically,
Assemble every product one at a time.
yeah, each unit gets assembled individually, right? So we can just put that as the answer. Again, you're not going to have to type these answers into Canvas, but you'll probably see there are multiple choice or true false for these questions. And so having an understanding of the answer will help you pick the right choice. Okay, how about issuing raw materials? So if the factory floor needs some raw materials, they would request a whole batch of raw materials at one point, not enough just for a single unit typically. And why is that? What's that? Oh, buy in bulk? Okay. So for the purchasing, yes, the more you purchase at a time, the cheaper the price is going to be. But even once you've purchased it, just moving it off the storeroom, I mean, that takes time and energy. So you wouldn't want to go do that for every single unit. For most products, if your unit is a spaceship or something very large, then maybe you do go get the materials for that one unit. But most products you assemble in batches, and you would get the materials for the entire batch at one time just to be more efficient. So we could say that raw materials are requisitioned by batch for efficiency. Something like that. Okay, what about machine setups? You set up a machine every time you make a product or for a whole batch of products. So typically it would be for a batch of products. And again, it's just more efficient, right? You set up your machine and then you just make, whether it's a small batch or a large batch, you process it all. Because if you're every unit, after every unit, you have to reset up your machines, that's going to be time consuming, right? So machines are typically used to process batches of products. Products at a time. And I'll put for efficiency. Eric, make sure you put your name on the list. All right, make sense? Okay, inspections. It says unit level. So why would we inspect individual product units? Okay, quality control. It's a nice brief answer. Yeah. Now, does that mean you have to inspect every single unit? Probably not. Most companies, especially if they're mass producing, they're going to sample. And if they find problems with the unit, then they might stop the production line and try to figure out what's going on. But typically it's too time consuming, too expensive to check every single unit. But when you are checking, you would look at a particular unit. You can't really examine an entire batch at one time, right? You have to focus in on each individual unit. Okay, so yeah, quality control, I think, is a good way to explain that. How about loading the labeling machine? Got a machine that just puts labels on your product? Why would you do that per batch of product?
Because you don't want to exchange the label every single time.
Okay.
Put it on the new product.
Okay. So more efficient to label multiple products. Label multiple products at a time. Okay. How about equipment maintenance? Doesn't really make sense to stop and maintain your equipment after every unit of product, right? Like you don't take your car in for an oil change after every time you drive it. Okay? So we could say it's unnecessary to maintain equipment after each use. For G, it says printing a banner unit level. So why would we print a banner individually instead of a whole batch of banners? Okay, yeah, banners are usually for a specific situation. So when they're ordered, it's usually individually. The banners are typically, we could say, customized. Customized per unit. You might have a situation where somebody needs multiple banners that are all the same. Maybe if they've got multiple stores and they want the same banner hanging in every store. But a lot of times companies just need an individual banner. Okay, moving material. So if you're moving material from point A to point B, again, just more efficient. Just move a whole batch of material at one time. Batches of material. Ordering parts, same thing. You know, you need a screw. You're not going to order one screw. You know, most companies aren't even going to sell you a single screw, especially not online. Maybe if you go into Home Depot, you know, you can buy an individual screw, but even there, they usually want you to buy a whole set. You only need one, but you have to buy a box of like 50 or something. So parts are typically sold in large quantities. Now there are exceptions. If it's a very customized or expensive part, you might be able to just buy an individual one. But hopefully that gets you an idea of why some of these manufacturing things happen at the unit level, some happen at the batch level. Any questions on this problem? All right, so then next we did number 8, right? Let's just take a look at what we did on number 8. So 8 was this one. Okay. Any questions on that one? Okay. Great. So we just have 14 and 15 left. That's 15, and here's 14. Okay. So it's this company's first year of operations. You give us all the data here. Oh, we're doing absorption and variable costing. Okay. Okay. So do you remember me saying absorption costing is what we've been doing all along, right? And variable costing is what's new. So first we're going to go through absorption costing. We're going to make this income statement. And then we'll see how it looks different with variable costing and how it impacts the net income at the bottom. Okay, so income statements start with sales. Okay, so this company's revenue is $5 million in sales. Now note here that they sold 100,000 units, but wait. Oh, yes, but it says cost of goods sold 120,000 units. Well, they didn't sell 120,000, they sold 100,000, right? So what we have to do here is figure out these costs of producing 120,000 units, but then figure out what are the costs of the 100,000 that got sold. Because the other 20,000 are still sitting in ending inventory, they didn't get sold. Okay, so that's what's a little different in this scenario. The direct material they gave us, that's based on 120,000 units that they produced. Same thing with the direct labor. Same thing with the variable and fixed overhead. And because we're doing absorption costing, fixed overhead is absorbed into our cost of goods sold. That's where the name comes from. So we put in the variable, we put in the fixed, manufacturing overhead. And then as usual, the selling and administrative expenses, those are going to be separate, right? Because that's not part of production and manufacturing. Those are period costs. So we're going to address those later on. So these are all of our production related costs. In this case, they separated variable and fixed overhead, but together they make up the manufacturing overhead for everything that got produced in this period. So to get a total, we just add it all up, all the costs. And so 4,500,000 is our total manufacturing costs for the period. But remember, we didn't sell all of that product, right? We only sold 100,000 units. So if this is based on 120,000 units, How do we figure out the cost of 100,000 units? If this number here, the subtotal of our manufacturing costs is based on 120,000 units that we produced, how do we figure out the cost of the 100,000 units we sold?
divided by that.
Okay.
And then, why about 20,000? Or
Well, okay, we could do that. So good answer, Joseph. So if we take the $4.5 million of manufacturing costs divided by 120,000 units produced, that gives us a cost of $37.50 per unit. Right? Now, 20,000 units did not get sold. Correct? So if we multiply this per unit cost times the 20,000 that did not get sold, that's $750,000 that's still sitting in ending inventory. We could take that same $37.50 cost per unit and multiply it by the 100,000 units that did get sold. And that then gives us the cost of the goods that were sold. Or an alternative would be we could take the total cost of producing the 120,000 units, subtract the cost of the 20,000 units that didn't get sold, and again, it gives us the cost of the goods that were sold. Okay, so we divided by the number of units that were produced. We get a rate per unit. And then we were able to use that rate to figure out the total cost of the units that were produced or sold. Any questions on that? What do you think is the next step here in this income statement? How do we figure out our gross profit?
We subtract the cost of goods sold from the sales.
Okay. Sales minus cost of goods sold gives us our gross profit, 1,250,000. Then we can subtract our selling and administrative expenses. And combined, that is $700,000, right?
Yeah.
Okay, so we'll subtract $700,000. And that gives us our net income of 550,000. Okay, so using absorption costing, that's our net income. It's pretty similar to income statements we've done in the past. The only thing is that we had to convert the cost of manufacturing into the cost of goods sold. All right. We ready for part B? Okay. So part B starts off the same. We have the same $5 million in sales. We have the same variable costs for manufacturing, direct material, direct labor, and variable overhead. However, the fixed overhead is not part of this calculation. And again, we would never share our variable costing income statement outside of the company. This is only for internal use, not to confuse our investors. So just looking at the variable costs, if we add those up, the variable manufacturing costs, we get $4,200,000, which makes sense because we did not include the $300,000 of fixed manufacturing overhead. And then could we use the same approach to convert that into cost of goods sold? Divide it by the 120,000 units that were produced, and then multiply by 100,000 units that were sold. We can. Let's do that. Divide by the 120,000 units that were produced. We get a rate of $35 per unit. Multiply that by 100,000 units, we get $3.5 million as our cost of goods sold. If we take that rate of $35 per unit of variable costs and we multiply by the 20,000 units that did not get sold, that's $700,000 in ending inventory. And we can see that's correct because if we had $4.2 million of costs for production of variable costs and 700,000 of that still in ending inventory, the difference of 3.5 million would be our cost of goods sold. Very. There we go. Okay. Glitch. Okay, so as I was saying, in this case, we're going to, from the sales, we're going to subtract the variable cost of goods sold. Okay, try it again. Oh, I should share a screen again. There we go. Okay, then we put in our fixed expenses. It was 300,000 for fixed manufacturing overhead, and then 440,000 for fixed selling and administrative expenses. It subtotal that over here, $740,000 of fixed costs. And then we subtract that from our contribution margin to get our net income. Of $500,000. So now we've made our variable income statement. The net income from absorption was 550,000, right? And from variable, it's 500,000. That's a $50,000 difference. What happened? Where did that $50,000 go? It's all the same numbers, right? That went into there. The same fixed costs, the same variable costs. What happened to our $50,000? Exactly. Yes. Up here, we included that fixed overhead, right? But then remember, some of this ended up in ending inventory. So under absorption costing, we have $750,000 of ending inventory, and those costs are getting shifted to the next period since they didn't get sold in this period. Under variable, there was only 700,000 in ending inventories. That's a $50,000 difference. That $50,000 stayed in this period and it decreased our profits. So we have $50,000 less net income. So exactly right, Joseph. Which again is why you would not share this outside the company, because it's going to confuse people. But it might be useful for managers that want to see variable costs separated out from fixed. Okay. Any questions on this problem? Okay. So we have one more. When did I say 15? Okay. We'll do 15 and then we'll be done. Again, if anybody has questions or if you weren't here on Tuesday, and you want to stick around, I'll be happy to go over things with you. This one is similar. We've got an absorption and a variable. Well, actually, they gave us absorption. We have to do the variable costing on this one. Okay. So let's see what they gave us. We have some per unit costs. We could tell it's per unit because it's so low, right? How many units were produced? How many units were sold? Here is the absorption income statement for our reference. And now we have to do the variable costing income statement and then a reconciliation. And the reconciliation is really simple. All we're going to do is put the net income from variable, the net income from absorption, which actually we already have that. It's 365,500 was the net income from the absorption income statement. And then we're just going to compare the two. Okay, so the reconciliation's quite easy. Let's make this variable costing income statement. Are the sales going to be the same as the absorption costing income statement? Yep. There's no difference in the sales because we're only changing the costs. Beginning inventory is going to be the same. Cost of goods manufactured. Okay. Well, let's think about this. I don't think we can use this cost of goods manufactured. Why not? Why can't we use that for the variable costing income statements? What might it include that would not be part of variable costing? Some fixed costs, that's right. Right, they would have included fixed costs in there in the absorption income statement, and we want only the variable costs. So we're gonna have to figure out the cost of goods manufactured ourselves. All right, so let's start by figuring out the variable cost per unit for manufacturing. What would that be?
Direct labor and manufacturing.
Okay, very good. So the direct materials of $15, the direct labor of $15, those are both variable, and the variable manufacturing overhead of $3. So $33 per unit would be the variable costs for production. And how many units did we produce? 27,000. So if we take the $33 per unit variable cost times the 27,000 units, that gives us $891,000 of cost of goods manufactured. Does that make sense? Okay. Since we had 0 beginning inventory, and we had $891,000 of manufacturing costs. The total cost of the goods that are available for sale is $891,000. We're simply adding those two together. And now we can separate it between ending inventory and the cost of goods sold. How did we do that again? Remember, we need to consider how many units were produced and how many units were sold. So if our cost of production was $891,000 of variable costs, what do I do? I hear somebody say divide. Divide? Yeah, exactly. Divide by 27,000. Very good, Christian. So that gives us a cost per unit of $33 in variable costs. And then we sold 19,000. So our cost of goods sold would be 627,000. How many units are in ending inventory? Okay, very good. So if we produce 27,000 and 19,000 got sold, that means we still have 8,000 that didn't get sold. So 8,000 units times that $33 cost per unit is $264,000 of ending inventory. And then to check that, we can just subtract here our total cost of goods available minus what's in ending inventory is our cost of goods sold. Okay. Does anyone have any questions on that so far? Okay. All right. So then let's see, gross profit. How do we get that again? Sales minus cost of goods sold, 1,273,500. Okay. We're also going to take out our sales and administrative expenses that are variable, which is 133,000. And now we have our contribution margin, 1,140,500. Then we could take out all the fixed costs. So we have fixed sales and administrative is 300,000. And fixed manufacturing, oh, they didn't give us that because remember they absorbed it into here. So what would be our fixed manufacturing costs?
The fixed manufacturing overhead per unit times how many units we make.
Exactly. The fixed manufacturing overhead per unit of $25 times the 27,000 units we made would be our fixed manufacturing overhead cost. So $675,000. So what we're going to do is add the fixed sales and administrative plus the fixed manufacturing costs to get a total fixed costs. And then we can subtract that from our contribution margin to get our net income. Okay, so once again, we have all the variable costs on the top Fixed costs are on the bottom. We then take our net income down here to our reconciliation. We see that with the variable costing, we made 165,500. Under absorption costing, it's $200,000 more than that. So the difference, the amount of cost that got shifted off into the future with absorption costing, but did not get shifted off into the future under variable, is $200,000. Okay, so now you know how to do variable and absorption costing. Are there any questions? All right. Well, if you don't need any help, then I'll see you next week. Otherwise, if you want to stick around, I'll be glad to help.